Hi, I'm Pattu from freefincal, and today let's talk about if Indian investors are ready to choose index mutual funds or ETFs. You may have seen in the past few months tweets and Facebook posts about index investing and passive investing have been on the rise. In fact, my own articles have increased on passive investing. But does it mean the market as such, or the whole set of mutual fund investors, I should say, are they ready to embrace this kind of passive investing? I've been wanting to write this post for a while, but then Zerodha's announcement yesterday that they have applied for a mutual fund license gave me a nice excuse. When the announcement came, immediately all sort of hyperbole was flown around that this is going to disrupt the industry and so on. They have said so far that they will be looking at uh, what did they say? They passive funds with a possible involvement of quantitative models. So people expect it to be low cost, similar to their brokerage model. But does it mean it's going to disrupt everything? That's not as if people are going to immediately drop their active mutual funds and rush to buy Zerodha mutual funds because they hopefully they're going to have the lowest total expense ratio. We don't know all that. It's too premature to talk about all that, but I'm going to show you some facts of how the index universe is in, or the passive universe is in the mutual fund space in India. So today you can actually choose a 2-star rated Nifty index fund, 3-star rated Nifty index fund, or a 4-star rated Nifty index fund. These are all funds having the same portfolios, and thanks to Value Research's wonderful algorithm, you have all these kind of choices. And there's a huge difference in returns among the Sensex funds or the Nifty funds. I'm talking about index funds, not the ETFs. And the reason is something that I have talked about earlier. High expense ratio and low AUM. Typically, an AUM of less than 100 crores is trouble for a mutual fund manager. They are not able to track the index because of redemptions, continuous redemptions, and inflows. Tracking error can be huge. And I've actually shown that there are 5 index funds that have bet their indices, so they're that bad. So you have to be careful when you choose the index funds. Uh, Decent AUM of more than 200, 300, 400 crores should be all right, combined with a low expense ratio. If you dig into AMFI data, you will find that the regular plan of UTI Nifty Next 50 index fund is accounts for 47% of its AUM. It's baffling. Why would somebody be a passive investor and pay commissions? It's just bizarre, but that's the sorry state of affairs. Mutual fund houses require distributors to push funds, especially NFOs. Otherwise, they will not get that enough AUM to justify all the costs that are involved, the promotional costs, the tweets, the paid articles, etc., etc. They cannot justify without such a big push from distributors, from banks, and so on. That is the sorry state of affairs. Even for index funds, pushing is necessary. And of course, not every index fund has got a significant regular AUM. UTI Nifty index, the regular AUM is 21%, but still 21% is high enough, in my opinion. The ETF universe is worse. There are many ETFs with just a handful of crores of AUM. Huge difference between NAV and price. And I've written a series of posts, also made a series of videos on comparing ICICI Nifty Next 50 versus Reliance ETF Junior Bs, SBI Nifty 50 versus UTI Nifty Index Fund, and so on. I've also shown how to choose ETFs. Look at those videos, have a look at these articles. I'm not going to discuss any further on ETFs. Then look at this picture. This is the blue line is the AUM of ICICI Nifty Next 50 direct plan. The NAV is shown in the red. Notice that the NAV zoomed up around this point in time between May 16 to September 2017, but the AUM zoomed up months later. So people saw that past performance and then invested. People are always investing on the basis of past performance. The increase in NAV happened here, the performance, the returns came here, the AUM happened here. And since January 2018, the fund has been falling down and has probably recovered a little bit recently. but the NAV has been underwater, and the AUM growth has slowed down. And in January 2020, look at that huge drop in AUM, because people have looked at the fund has not given returns for the past 2 years now. What was a 5-star? When they saw the fund at this point, it was a 5-star rated fund according to Value Research. Today, it's a 2-star rated fund if you look at direct plan, 3-star if you look at regular plan. So that's that reason is because Value Research is treating them differently, which is wrong. But well, Value Research is doing 100 things wrong. This is 101. So that's the problem. These are not index investors. They are looking at performance and they invested. And when the performance is not there, they pulled out. That's not index investing. Index investors will not do things like that. So India is a long, long way from becoming a major passive market. So, and one more thing, if you look at the, if you go to Value Research and if you sort the large cap funds according to the last 1 year data, that is the last 1 year trailing, there will be the top 24 funds, regular and direct plans, will be actively managed mutual funds. If you look at the last 1 year data, only in the 25th spot you will find the first index fund or ETF. That so suddenly these funds have understood that Sensex and the market has diverged. Sensex and Nifty stocks are moving up, at least some of them, and the rest of the market is kind of not moving as much, and they have responded to it, at least some of the active fund managers. So does this not mean active investing is still relevant and so on? I'm not going to say that. The point is, most mutual fund investors are casual investors. They will only look at last 1 year return, last 2 year return, last 3 year return. They will not look into rolling returns to like we have shown, only 5 large cap funds have comfortably bet the Nifty 100. And even in 2010, S&P index, the SPIVA report, the S&P report said that active fund managers are finding it difficult to beat large caps fund. That's what Avinash Filtri had written an article about. So people are not going to do that kind of research. They're going to look at casually. They're going to look at the returns. And if you look at the last 1 year returns, it looks as if index funds are doing well, and the stars of the index funds are moving up. Actively managed, the stars of the index funds are going down. The actively managed funds are getting more stars in the because the star rating is in the last 3 year and 5 year window combined. So true passive investor, where they will not look at peer performance, they will not look at star ratings, they will not look at past performance, they will just blindly follow the index returns. We are a long, long, long way from that. Zerodha, I'm not saying Zerodha will be unsuccessful. I'm only saying to say that Zerodha will be disruptive is a little immature. There is a lot of room available. There are the in the industry, there are very, very few mutual fund investors are there. The moment there is a crash, even